The silver market just got detonated overnight. We smashed through 32.15. Wait, scratch that. We're way past it now. Last night, Comex paper silver ripped higher, closing the session blasting through resistance levels that the banks have defended for years, surging over 9% in a single move to hit $77.85 as the bells rang in New York. That's not a rally, that's the beginning of the re-short squeeze explosion we've been warning about for months. It's here. The rigged paper game is cracking and physical reality is finally smashing back. Listen close. This wasn't some random retail frenzy or a Fed whisper. This was coordinated. The commercials, the big banks like JP Morgan, the same ones that paid billions in fines for spoofing and banging the close, had massive short positions stacked against silver for years. They suppressed it below $30, then $35, then pretended $40 was the ceiling. But the math doesn't lie anymore. Global industrial demand is exploding. Solar panels alone are sucking up over 300 million ounces a year. EVs and AI data centers are piling on another 150 million. Mine supply, flatlined, recycling, not keeping up. We're in year 5 of structural deficits, and the warehouses are getting gutted. Connect the dots. While Comex paper was allowed to trade at discounts for months, sometimes $2, $3 below real physical, Shanghai was screaming the truth. Just check the Shanghai Gold Exchange benchmark. Physical silver. There is commanding premiums that translate to over $81, $82 an ounce in USD terms right now. That's the real price, the one refiners, jewelers, and actual users pay when they need metal tomorrow, not in 6 months on some futures contract. The disconnect is obscene. Comex is the rigged casino where JP Morgan and the bullion banks can naked short paper contracts with almost zero fear of delivery. Shanghai? That's where the metal actually changes hands. And right now, the East is paying a fat premium because the West's paper promises are starting to look worthless. This squeeze didn't start yesterday. It built for years. Remember 2025, silver ripped to $83, shorts got torched, lease rates spiked to levels we hadn't seen since the Hunt brothers. Banks paid $1.3 billion in fines. A couple of JPM traders even did time. Did that stop them? Hell no. They just reloaded. But the physical world doesn't care about their spreadsheets. India pulled in massive tonnage last year, China stockpiled quietly, and now with tariffs looming again and geopolitical fires everywhere, nobody wants to sell physical at these suppressed levels. And here's the pivot, the secondary warhead that's about to make this thing go nuclear. Geopolitics isn't background noise anymore. We're staring down escalating tensions in the Middle East, supply chain fractures from Red Sea disruptions to Taiwan flashpoints, and the dollar weaponization pushback from BRICS nations. Russia and China are dumping treasuries, buying gold and silver, and building parallel systems. If one more major player, say another central bank, decides to back its currency with physical metals instead of paper promises, the run on physical silver accelerates. Add in potential bank stress. Remember Silicon Valley Bank? That was child's play. If we get a real credit event in 2026, liquidity dries up and the shorts get margin called hard. Paper silver gets called for delivery, and there isn't enough metal in the warehouses to cover even 15-20% of open interest if everyone stands for it. I've been in these markets since the 90s. I've seen manipulations, squeezes, blow-offs. This one feels different because the fundamentals are aligned for the first time in decades. Industrial consumption is structural, not cyclical. Supply is inelastic. Mines take 10 years to bring online. Demand is inelastic too. Solar, EVs, 5G, semiconductors don't run without silver. The paper overlay is finally getting dislocated from reality. The shorts are panicking now. COAT reports show commercials still net short hundreds of millions of ounces, but the managed money longs are piling in. Retail is waking up again. SLV inflows are spiking. Physical premiums on Eagles, Maples, and bars are exploding to $8, $10 over spot in some dealers. That's not normal. That's fear of not getting metal at any price. We're in the acceleration phase. Overnight moves like last night's breaking multi-year resistance with volume signal the algorithm traders flipping sides, the weak hands getting flushed, and the real players stepping in. This isn't going back to $30. Not this cycle. The floor is gone, the ceiling, we don't know yet. But when Shanghai trades at 85.90 equivalent and Comex is forced to catch up, that's when the real fireworks start. 3 key takeaways and we're out. 1. Physical wins, paper loses. The arbitrage gap between Comex suppression and Shanghai reality is the smoking gun. Buy physical now, coins, bars, whatever you can verify, because paper promises are getting exposed every day this squeeze builds. 2. The banks are on the ropes. JP Morgan and the commercials have manipulated silver for decades, but deficits don't lie. When delivery demands hit and inventories can't cover, forced covering will rocket the price. This is their nightmare scenario playing out live. 3. Stack while you can. This move isn't over. Geopolitics, industrial hunger, and short covering momentum mean silver could test $90, $100, even higher in the coming months if the fuse keeps burning. Don't wait for the talking heads to say it's safe. The safe time was yesterday. Today is the war zone. Stay sharp. Verify everything. The system is rigged, but reality is undefeated. Out.